In 1985, a company was founded that would change the face of corporate America forever. It was called Enron, and its rise to power was as meteoric as its fall was catastrophic. This is the story of one of the most infamous corporate scandals in history, a tale of greed, deception, and the devastating consequences that followed. Enron began as a humble natural gas pipeline company, founded by Kenneth Lay in Houston, Texas. But it didn't stay humble for long. Under Lay's ambitious leadership, Enron rapidly expanded its operations, diversifying into various energy markets, including electricity trading and even broadband. By the late 1990s, Enron had transformed itself into one of the largest energy companies in the world. Wall Street was enamored with Enron. The company was hailed as an innovator, a disruptor in the energy sector. Its stock price soared, and its executives, including founder Kenneth Lay, CEO Jeffrey Skilling, and CFO Andrew Fastow, were celebrated as visionaries. Enron's energy trading division, in particular, was seen as revolutionary, allowing the company to buy and sell energy contracts on behalf of customers. But beneath the surface of Enron's apparent success, a sinister web of financial deception was being woven. The company employed a system of highly questionable accounting practices that would eventually lead to its downfall. One of these practices was mark-to-market accounting, a method that allowed Enron to book projected future profits as current income, even if those profits were uncertain or unlikely to materialize. This creative accounting gave the illusion of constant growth and success. Enron's financial statements looked impressive, with revenues climbing year after year. But it was all a house of cards, built on a foundation of lies and manipulation. Another key component of Enron's deceptive practices was the use of special purpose entities, or SPEs. These were essentially off-the-books partnerships that Enron used to hide its mounting debt and inflate its profits. By shifting liabilities off its balance sheet, Enron was able to make itself appear far more profitable than it actually was. One of the most notorious examples of these SPEs was a partnership between Enron and a company called LJM. This partnership was set up by none other than Andrew Fastow, Enron's CFO. LJM was used to hide Enron's massive debt, allowing the company to report profits while continuing to accumulate enormous amounts of debt that were not disclosed to investors. As Enron's apparent success grew, so did its stock price. By mid-2000, Enron's stock had reached a high of nearly $90 per share. The company was considered a Wall Street powerhouse, and its executives were lauded for their visionary leadership. But even as Enron's stock price was reaching its peak, the company's true financial health was deteriorating rapidly. The accounting practices used to inflate profits and hide debt were becoming increasingly unsustainable. Yet Enron continued to expand, acquiring new businesses and making bold claims about its future growth. The executives, drunk on their own success and blinded by greed, pushed forward, ignoring the warning signs that were becoming increasingly difficult to ignore. In 2001, the cracks in Enron's facade began to show. In October of that year, a report by the Wall Street Journal raised questions about Enron's complex financial dealings, particularly its use of SPEs. This report sent shockwaves through the financial world and marked the beginning of the end for Enron. The company's stock price, which had already started to decline, began to fall rapidly. This decline was exacerbated when Enron was forced to disclose that it had overstated its earnings by nearly $600 million over the previous few years. In November 2001, Enron announced a staggering $618 million loss for the third quarter, confirming the fears of many and signaling the imminent collapse of the once mighty corporation. As the company teetered on the brink of collapse, an unexpected hero emerged from within Enron's own ranks. Sharon Watkins, an Enron vice president, blew the whistle on the company's fraudulent practices. She wrote an anonymous letter to Kenneth Lay, warning him of the financial and legal risks that Enron was facing due to its accounting practices. Watkins feared that Enron's deceptive accounting would eventually be exposed and result in massive financial losses. Her warnings were prescient, but tragically, they went unheeded. Instead of acting on this information, Lay and other executives attempted to cover up the issue and continued to mislead investors. The final nail in Enron's coffin came in December 2001. The company admitted to a massive accounting fraud, revealing that its debt had been hidden through the use of SPEs. On December 2, 2001, Enron filed for bankruptcy in what was at the time the largest corporate bankruptcy in U.S. history. The collapse of Enron sent shockwaves through the financial world. Thousands of Enron employees lost their jobs and retirement savings, many of which were invested in Enron stock. Shareholders and creditors, including banks and investors, lost billions of dollars. The human cost of this corporate fraud was immense and far-reaching. But the story of Enron's collapse doesn't end there. The scandal also engulfed Enron's accounting firm, Arthur Andersen. The firm had signed off on Enron's fraudulent financial statements, allowing the company to mislead investors and regulators for years. After the bankruptcy was announced, it was revealed that Arthur Andersen had destroyed key documents related to its audits of Enron. This led to accusations of obstruction of justice. In 2002, the firm was convicted of obstruction of justice for destroying evidence, although the conviction was later overturned by the Supreme Court. Nonetheless, Arthur Andersen's reputation was irreparably damaged. From here, the legal fallout from the Enron scandal was extensive. Several of Enron's top executives were arrested and charged with crimes related to the scandal. Jeffrey Skilling, who had replaced Lay as CEO, was convicted of fraud, insider trading, and conspiracy. He was initially sentenced to 24 years in prison, though his sentence was later reduced on appeal. Kenneth Lay was also convicted of fraud and conspiracy, but he died of a heart attack before he could be sentenced. Andrew Fastow, the CFO who orchestrated many of the fraudulent deals, was also charged with a range of crimes and pleaded guilty. He was sentenced to 6 years in prison but was released after serving just over 4 years. The Enron scandal had a far-reaching impact on corporate governance and financial reporting practices in the U.S. It led to a loss of investor confidence and highlighted the need for greater transparency and accountability in corporate financial reporting. In response to the scandal, the U.S. Congress passed the Sarbanes-Oxley Act in 2002. This law introduced sweeping reforms aimed at improving corporate governance and accountability. It mandated stricter oversight of corporate accounting practices and increased penalties for corporate fraud. The Enron scandal also led to increased scrutiny of accounting firms and the practice of auditing, prompting regulatory changes to prevent such widespread fraud from occurring again. It exposed the dangers of unchecked corporate greed and the lengths to which executives would go to maintain their lavish lifestyles, while employees and investors paid the price for their dishonesty. The bankruptcy also revealed the risks of relying too heavily on financial innovations that lack transparency and adequate oversight. It became a cautionary tale for businesses, investors, and regulators about the dangers of corporate fraud, the importance of ethical business practices, and the need for robust oversight in financial markets. Though Enron's name has become synonymous with corporate fraud, its legacy continues to affect corporate governance and regulatory policies worldwide. The fallout from the scandal led to increased emphasis on ethics and transparency, and the creation of stricter regulations aimed at preventing corporate corruption. The collapse of Enron was a key turning point in the world of corporate finance, making it one of the defining business scandals of the 21st century. It serves as a stark reminder of the devastating consequences that can result when greed and deception are allowed to flourish unchecked in the corporate world. As the first light of a new era in corporate accountability crept through the window, the ghost of Enron's misdeeds continued to haunt the corridors of power in the business world. The lessons learned from this scandal would echo through boardrooms and classrooms for years to come, a chilling reminder of the price of unchecked ambition and the importance of integrity in the face of temptation.